Okay, uh, today's topic is accounting dates and basis of assessment. Today's topic is accounting dates and basis of assessment. So that's what we are going to look at today. We're going to look at this particular topic, knowing full well that when you look at any organization that is running formally, you find that there is what is known as accounting period. So this is the period of account. Then when we come to taxation as well, we are advised that there is what is known as tax year, okay, or fiscal year. So now we are going to look at how do we base our assessment. On what do we base our assessment when it comes to this particular topic? What you should know is that there are different situations that can arise when it comes to a taxpayer being confronted with the possibility of paying tax. There is sometimes when you see that you are just starting your business, so we need to mark what is known as the commencement date. Sometimes you might have a situation whereby you have to be assessed given the situation that you are ceasing your trade. So we have also rules in this particular respect to do with the cessation of account of a trade. And we also have other interesting points that we're going to look at. So just to start with, not to waste a lot of time, let's look at what we have to do first. Basically, I want to tell you that in covering this particular topic, you should be at the end of these particular sessions be able to explain what is meant by a basis period, and also be in a position to explain what is meant by the current year basis and the preceding year basis. Further to that, you need to explain the circumstances under which current year and preceding year basis apply, and further prepare income tax assessment for businesses, and prepare income tax assessments involving commencement, cessation, and also another situation could be the change of accounting date. So for the commencement, cessation, and change of accounting date, we are going to learn about the rules that we need to apply. So we start with looking at what is known by the basis period and basis of assessment. To guide you in this particular respect, a basis period for a given tax year can be taken to be an accounting period whose profits are to be assessed in that particular fiscal year or tax year. That is what we call a basis period. Okay? Then we also need to look at the other flip side, the flip side of it. We can say the basis of assessment is a set of rules. Okay, the basis of assessment, remember, is a set of rules for establishing a basis period. And therefore, it is important to consider the basis of assessment in order to come up with a basis period for any fiscal year. So those are very important definitions to have in mind or keep in mind. You need to understand what is the basis period. As I've said, for any given financial year or tax year, there is an accounting period whose reported profits are to be assessed in that particular tax year. Assessed for what? Assessed for income tax or for tax purposes. Then I've said the basis of assessment. How do you assess that income? So in this particular second definition, the emphasis is that we need to use or apply a set of rules for us to be in a position to establish a basis period. Now, what you should also be comfortable with is that there can be accounts prepared to a date falling between 1st April and 31st December. Okay? There can be accounts prepared between 1st April to 31st December, meaning the accounting date falls between this particular interval of time. When we have accounting date falling between 1st April and 31st December, then you should remember that the basis of assessment will be the current year basis. The year in which the accounting period ends is the year in which the resulting profits are assessed. Hence, it is termed the current year basis. So, let's look at an example for us to understand what is the current year basis of assessment. Here we have Mr. Mburuma.
Sorry, excuse me, sir.
Yes, please.
The slides, they're changing. From the time we started, they are not changing.
Okay, let me... are you able to see the slide now?
Yes, sir.
Okay, so I'm coming from this particular slide. This one, you saw it. Okay, where I explained about the basis period to be a tax year, or for any tax year to be an accounting period whose profits are to be assessed in that particular tax year. Then when I talk about the basis of assessment, this is simply reminding you that the assessment will be by employing or using a set of rules for establishing a basis period. So that's the emphasis being laid there. So I said, given that we have these two definitions, let's see how we make use of this knowledge by way of looking at an example. So we have Mr. Mburuma has been in business for many years, prepares accounts to 31st December each year. Okay? He has provided the following tax adjusted trading results for the most recent accounting period and periods rather. So you have these three periods shown. The year ended 31st December 2019, then you have the year ended 31st December 2020, and the year ended 31st December 2021 with accompanying profits. What is our task in this particular regard? Our task is to show the income tax assessments for all the relevant tax years, identifying basically the basis period. Okay, so that's what our task entails. So let's look at how we start looking at that. I've mentioned in this particular case a number of points that we need to focus on in solving this particular problem as follows. Point number one is, you note that when you look at this particular example, okay, you are noting that the year end is 31st December. Year end is 31st December. So when you look at the basis of assessment, we talked about the current year basis, okay? And the current year basis is where accounts are prepared to a date falling between 1st April and 31st December. 1st April and 31st December. So when you look at this particular example, the year ends at 31st December, meaning that it is in compliance with this rule, which is requires us to use current year basis, because the 31st December is falling in between this interval, 1st April and 31st December inclusive. So meaning that we are comfortable to proceed and use the current year basis. Okay, so under the current year basis, an accounting period is the basis period for the tax year in which the accounting period ends. Okay, so that's what you should know. And then we are going to see that the areas of the periods given is the tax year 2019 in this particular case. That's the earliest period. So it's the tax year 2019, which is year ended 31st December 2019. That's what we have. Okay, we proceed now. Once we have established those particular points, we proceed to look at this particular assessment. So you write income tax assessment on a current year basis. CYB simply means current year basis. So to identify the taxpayer, you indicate the name Mr. Mumburuma there. Okay, so the income in the first period, the 1st December, will be assessed in the tax year ended 31st December 2019 itself, because we are using current year basis. So that's what we are saying. Tax year 2019 basis period, year end 31st December 2019, and the amount is what is indicated there is 45,850. So that's what we are going to put even there, 45,780. So coming to 2020, again, we are going to use the current year basis. Why? Because the year ends, or the accounting period, or the counting date ends between 1st April and 31st December inclusive, being 31st December 2020. So it means that we're even here with a profit of 51,200, we are going to use the current year basis. So you just go into to present this particular schedule. So you say tax year 2020, that's the tax year we're looking at. What is the basis period for the profit which is end for the year end 31st December 2020, and the amount is 51,200. Equally the same applies to 2021. If you may look at that, you realize that again is year end 31st December 2021. 31st December is falling between 1st April to 31st December. According to the rule, means that we have to use the current year basis. We have to use the current year basis. So again, there's no difference except for the year. We have tax year 2021. We look at the period of the income is year end 31st December 2021, and the figure is 55,650 to be assessed. So that's how we determine the income tax assessments on current year basis for the taxpayer, Mr. Mburuma. Okay, so that is how we use the current year basis. Let's look at another example in this particular regard. We have tax adjusted trading result produced by Mr. Chanda, who prepares accounts annually to 31st October. Okay, who prepares accounts annually to 31st October. Okay, let me just put this adjustment here. Okay, so indeed here what do we have? We have year end 31st December 2019, 45,780 again. Then year end 31st October 2020, 65,800. Year end 31st October 2021, 55,650. What is our task? we are required to show the income tax assessment for all relevant tax years, identifying the basis period. So the first thing is to find out when in the account, when in the year end for these accounts. So all of them, the year end is at 1st October 2019. So what does the rule say? The rule tells us that if you are going to have accounts prepared to a date falling between 1st April to 31st December, it means you have to use the current year basis. So 31st October falls between this. So again, meaning that here we have to use the current year basis. We have to use this current year basis. So again, when you look at this example 2, the first period to deal with is year end 31st October 2019. That's the first one. Then followed by that which ends 31st October 2020, in a similar manner to what we have just looked at. So if you look at that, you realize that you have tax year 2019, and there's a year end 31st October 2019. The figure is 45,780. So you have the 3 columns: tax year, basis period, and the profit. So equally for 2020, you have the year end to 31st October 2020, and the figures you put as the 5,800. Equally for 2021, you identify the taxes 2021. Which income are you assessing? Which period was it end? That's a basis period. Year end 31st October 2021, amounting to 51,240. Okay, so that's what we were asked to show. That's what we were asked to demonstrate, okay, or calculate or present. So the first 2 examples are pretty simple. They are telling us to show the assessments on the basis of current year basis. So on the basis of current year basis. So do you have any challenges? Any challenges arising? Any clarifications? Okay, then we...
No.
Okay, fine. So we proceed to another part. Now, we are coming from a situation where accounts are prepared to the date falling between 1st April to 31st December. We now look at, suppose accounts are prepared to a date falling between 1st January and 31st March. Okay? Same year, inclusive. So when this situation arises, when you see that accounts are prepared and the accounting date are falling between 1st January and 31st March, same year, then the accounts are prepared, the assessment will be on the basis of preceding year basis. Preceding year basis. So profits on accounting period ending at any time between these dates stated are assessed in the preceding year. So if you have they say the profits which are falling between 1st January and 31st March of 2023, it means that this profit will be assessed in 2022. That is what it means by preceding year basis. Okay, so let's look at an example so that we can see how these rules are applied. Okay. So we have example 1. Tax adjusted trading result produced by Mr. Kabwe who prepares accounts annually to 31st March. So mark the date. So it's 31st March. Okay, what does it mean? Already we are able to tell that this is going to be a preceding year basis, because the rule is very clear. Once the accounting date falls between 1st January to 31st March the same year, then you have to use preceding year basis of assessment. So this is what is going to obtain here. So year ended 31st March 2019, 65,980. Year ended 31st March 2020, 72,450. Required. Show the income tax assessments for all the relevant tax years, identifying the basis period. Okay? So I'm using these simple examples just to drive the point home, so that you are able to understand fully how to apply these rules. Because I believe if you understand this simple example, no matter how complex the question can be, by merely applying the principles, you still go through. Okay, so that's the idea behind. So let's look at how we sort out this particular simple problem. How do we sort out this particular simple problem? So again, I start by identifying points of interest. When you look at that, some of the points I've already touched upon. You notice first of all that the accounts are prepared to 31st March. Hence, you are using preceding year basis. Second point, accounting period ending in one tax year is a basis period for the preceding tax year. Okay, so like if it ends in 2020, then 2019 will be the one that is going to be used. Okay, that's what this point is talking about. Accounting period ending in one tax year is the basis period for the preceding tax year. Okay, the earliest of the accounting periods ends on 31st March 2019. According to this question, that's the earliest periods of account. We have 2019, 31st March 2019. That's what you show with the 5,980 kwacha. Okay, so that's what we have. And then the tax year in which the period ends will therefore be 2018. Why? Because we are using the preceding year basis. Okay, for the earliest period of year end 31st March 2019, the tax year in which the period ends, is therefore 2018, where we're going to make that particular assessment. Next accounting period is the basis period for the following year. That is the next accounting period, which following year 2019. So let's look at that particular situation and see how it should be presented. Again, you look at the tax year. 3 columns are supposed to be generated: tax year, basis period, and the profit to be assessed. Okay, so that's what we're going to look at. So you have the tax year, basis period, and profit to be assessed. So meaning that we are moving a year, we lag a year behind. That's basically what preceding year basis is all about. So the solution will be income tax assessment on preceding year basis for the taxpayer, Mr. Kamwe. So we have the tax year, basis period, and then we have the profit. Okay, tax year, basis period, and then the profit. So for tax year 2018, the income tax assessed will be coming from that which is generated in the year ended 31st March 2019. So that's how to are going to do here. So the period of generation of income is 1 year ending 31st March 2019, that profit is the basis of calculating the tax in the tax year 2018. That's why we are calling it basis period. And the profit generated in this period is the 5,980 kwacha, which will be calculated in the tax year 2018. Equally, for the year ended 31st March 2020 with a profit of 72,450 as per question, you see that since it is got the year ended 1st March 2020 and it's before this 31st March is falling between 1st January and 31st March inclusive in the same year, then we are going to use the preceding year basis. So that's the basis assessment. So we are going to still use the preceding year basis for this. Okay, so that's what we're going to see. So as a result, we have 2020 being assessed in tax year 2019 preceding year basis with the amount of 72,450. So that's what we mean by preceding year basis. I suppose that is also very clear. Any challenges? Okay. Any challenges? So having looked at that, look at the second example. Okay. Second example. Just to underscore the point, again, and this one we are dealing with Mr. Chabota. Tax adjusted trading result produced by Mr. Chabota, who prepares accounts annually to 28th February. So immediately look at the accounting date, you start wondering, should I use the current year basis or should I use the preceding year basis? So where does 28th February fall? It falls between 1st January and the 31st March. So meaning that you have to use the preceding year basis. You have to use the preceding year basis. So equally, you are going to use the tax year 2019 and the tax year 2020, since you are going to use the preceding year basis. That's where this income generated in 2020 and the 2021 will be assessed. Okay, so that is preceding year basis. So in a similar manner, if we had to look at the solution, I've already mentioned what you look at, you find that the solution will be as such. You have accounts falling between 1st January and 31st March same year, so this is the preceding year basis. And the areas for the tax year given is 2019, which will be assessed in 2020. Let me look at this. Look at this one. Yeah, 2019. No, sorry. Yeah, it's 2020. So it will be assessed in 2019. That's the first one. Okay, so 2019. So that's what we are going to look at. Equally for that one, which is generated in 2021, since we are using preceding year basis, the tax year in which that income will be assessed in 2020. And that's how they will come up with this particular presentation. So again, you take note that you have to show the tax year involved, and then the basis period, meaning the period in which the profit was generated, which is going to be used to calculate the tax in 2019, and the amount involved, the profit in this case. So that's what you do. So that's hence you have income tax assessment on preceding year basis for who? For the taxpayer, Mr. Chabot. Okay, so again, that is what we have. That's what we have. Okay, now I'm going to look at another important set of rules. This set of rules relate to commencement of business. So we want to see what rules for accounting dates and basis of assessment can be applied when the business commences. What are the applicable rules? Okay, a few things to note is that if the first accounting period is made up of exactly 12 months, these are a set of rules. If the first accounting period is made up exactly 12 months or less, then normal rules should apply. When we say normal rules, we imply that either, as just as we have looked at, either you are looking at the period of account, year end falling between 1st April and 31st December, therefore you apply current year basis, or you are looking at the accounting date falling between 1st January to 31st March, therefore use preceding year basis. So that's what we mean by normal rules apply. Next, looking at if the first account period is made up of more than 12 months, okay, if it is made up of 12 months, then you should know that the period is split into two notional accounting periods for tax purposes. Two notional periods for tax purposes. What are these two notional periods for tax purposes? The first period should consist of less than 12 months, and the second period should consist of exactly 12 months. Okay, so you split the long period, with a period which has more than 12 months. Okay, the last period should always exactly equal 12 months. Then the balance should be relating to the first period. Okay, so once you have split that into that fashion, you make sure that the profits also allocated to the notional periods on the time basis. What do we mean by time basis? For instance, if you are looking at a period of 15 months, then you make sure the second notional period is exactly 12 months, which leaves the first period with 3 months. So when you look at the reported profit, you are going to come up with a proportion. So for the 3 months out of the 15, then multiply by that profit. So that's what you allocate to the first notional period, which is of 3 months in this particular case. So the last notional period, which is supposed to be 12 months exactly, will be found by 12 over 15 times the total profit. So that will give you how much profit is allocated to the second notional period. Okay. Then once you have done that, thereafter the normal rules apply to assess trading results. So that's what you should know. Okay, that's what you should know. So let's look again at an example and see how these rules are applied. Okay, so in this particular case, I have Mr. Mulembwe, who commenced trading on 1st January 2019. And prepared accounts for the 3 months period ended 31st March 2019. He continued to prepare accounts for the years ended 31st March thereafter. Okay, so Mr. Mulembwe commenced trading on 1st January 2019 and prepared accounts for the 3 months period ended 31st March 2019. Okay, so he continued to prepare accounts for years ending 31st March thereafter. So the trading results as adjusted for tax purposes for the first 3 accounting periods have been as follows. So we have the 3 months, okay, which is 3 months period ended 31st March 2019. Then we have year ended 31st March 2020, year ended 31st March 2021. Okay, so that's what we have. So show the income tax assessment for the years 2018, 2019, 2020, identifying the basis period. So when you look at the period end, it is indicating to us that the period end falls between 1st January and the 31st March, meaning ordinarily we are supposed to apply the preceding year basis. Okay, now we also have a short period of 3 months, okay, ended 31st March 2019. Thereafter we have a year ended 31st March 2020. Okay, so that's what we'll do. Let's look at the important points to note in sorting out this particular problem. Okay, let's look at the important points to note in sorting out this problem. So accounts prepared to 31st March has preceding year basis. The first period is less than 12 months. Still, the preceding year basis is applicable in 2018. Okay, the subsequent two accounting periods are the base period for the following 2 tax years. 2 tax years. Okay, so that's what you have, and we come up with again the column, the income tax assessment for Mr. Mulembwe on preceding year basis. So the 3 columns of 3 famous columns are supposed to be used still. We have tax year, basis period, and profit. Now, when you look at this particular one, okay, the first one is 3 months ended 31st March 2019. Since it's ending on 31st March, the preceding year basis, meaning that the tax year which is going to be used for the first one will be 2018 tax year. 2018 tax year. You have tax year 2018. And the basis period, this period end, if you want, you can say 3 months ended 31st March 2019 with a profit of 25,400 to be assessed in the tax year 2018. Then the next one, when you look at this, you find again that there is a year ended 31st March. 31st March is a period, is a date which falls between 1st January and the 31st March. Okay, and the figure is 78,000. So according to the rule, we are supposed to use the preceding year basis, meaning that the profits of 78,000 which was generated the year ended 31st March will be assessed in the tax year 2019. Okay, 2019. We always lag a year behind in this particular case. So meaning that for the year ended 31st March 2021 with 96,400, we are going to lag behind because this is a preceding year basis. Again, means that to be assessing the tax year 2020. Okay, so that's what is going to be seen happen in this particular case. So hence the presentation of this nature for Mr. Mulembwe. Okay, so that's what you see in this particular regard. Let's look at any question if you have. Do you have any questions? You are free to seek clarifications.
No questions, sir, so far.
Okay, very good. Then means we proceed. Look at example 2. Example 2 deal with Timbwi. Okay, Timbwi commenced to trade on her own account on 1st September 2020, and we are told that she prepared the first account for the 16-month period ended 31st December 2021. Okay, she then prepared the next account for the year ended 31st December 2022. Her tax adjusted result for the period of trading as follows. So again, this is Timbwi. We have Timbwi in this particular case. We have Timbui in this particular case. Okay, we make them bigger so that you see. Okay, I believe you can see nicely. Okay, fine. So now, what is it that we're supposed to look at? Okay, we realize that in this particular case, we are told Timbui commenced trade on 1st September 2020. Okay, that's what we are told, and she prepared the first account for 16 months to 31st December 2021. So this period of account, the first one, this 96,000 was earned over a 16-month period from 1st September 2020 all the way to 31st December 2021, 16 months. So in this particular case, we have to split this period into two notional periods. As I told you, the last accounting period should be always equal to 12 months. Then the balance is what remains for the first period. So the last 12 months is from 1st January 2021 to 31st December 2021. Meaning from 1st September 2020 to 31st December 2020 remains to be the first notional period. So if you count September, October, November, and December, that will give you the 4 months. And then from January all the way to December 2021, that gives you 12 months. Together, you have 16 months. Okay? So now we have this profit, which is 96,000. As I guided before, you have to split this profit into two notional periods on time basis. So since now we have 16 months, the first notional period is 4 months. We are going to use the fraction 4 months, that is here. Look at the fraction. Okay, we're going to say 4 months divided by the total, which is 16 months. Okay, then once we've divided that, we multiply that one by 96,000. Okay, so that we know how much of that 96,000 will be allocated to the first notional period. Equally, when it comes to the second notional period, that will be exactly 12 months. You divide by the total months covered, that is 16. You are going to have that figure multiplied by what you are portioning, 96,000. Okay, 96,000. So we end up having 72,000. So one is 24,000, the other one is 72,000. That's what we are going to see being apportioned into two notional periods. Okay, so when you look at that, you're going to see exactly that. To say the accounts to date to a date falling between 1st April and 31st December, therefore current year basis altogether. Then the first account period exceeds 12 months. Therefore, we split it into two notional periods as given here. As a result, 3 accounting periods can be generated. Okay, 3 accounting periods will be generated. So let's see how this will be now done. So of course, there is a period which is 4 months to 31st December 2020. We have 24,000. Then the last notional period, which is 12 months to 31st December 2021, we have 72,000. Then the other one, which normally flows, year end 31st December 2022, we have 84,000. Then we apply the normal rules. Apparently, for these particular periods, they are falling between 1st April and the 31st December, so we use the current year basis. So use the current year basis. So that's what we are going to see happen. We use the current year basis. So Okay, we have 2020. We have the solution. Okay, 2020. This is what we have got. Okay. Okay, 2020. We have 2020 current year basis, not preceding years, but current year basis. That's what we have. Let me just change current year basis here. Okay, fine. So current year basis. So we see the 24,000 is assessing the tax year itself, 2020. The 72,000 is assessing the tax year itself, 2021. The one with the year ended with December 2022 is also assessing the tax year 2022 with 84,000. So that's what we have. That is what we have for today. I think for today we have looked at how do we identify that is a current year basis. How do we identify that is a preceding year basis to apply. We have learned what is the basis period and what is the basis of assessment. And we have looked at how do we make an assessment when the business has just commenced trading. Commence trading, and we have seen how do we treat a situation where the period of account is more than or exceeding 12 months. We split it into two notional periods, as has been evidenced by example 2. So those are the most important things that I want you to take home with for this out of this presentation. I think we are going to end here unless you have other questions. When we next meet, we are going to look at the rules which deal with cessation of business. Okay, cessation of business. How do you deal with the cessation of business for tax purposes? Any question? Okay, thank you for listening. I think we end here. We'll look at the cessation of business at the next set of presentation.
Nope.